A rebound in long-dated treasuries is running out of steam after the US Treasury announced plans to at least double its planned purchases of 10 to 30-year US debt. The move under Scott Bessent was responding to a surge in long-term borrowing costs. Very pleased to be joined in the studio by our markets live strategist Skylar Montgomery Koning in now. Skylar, this is quite unusual, isn't it? The last time this happened was Operation Twist, I think?
Yes, I mean, Operation Twist was under very, very different circumstances in terms of it was post-GFC. You had the Fed at the zero lower bound, and they said, well, how do we stimulate the economy from here if we can't cut policy rates any lower? We'll buy at the long end, so that puts long end yields down. It releases some pressure on the mortgage market, and it's meant to be stimulative. And right now, we don't need stimulative policy. And I think the other unusual bit of it is this buyback program in particular is meant to help with market functioning and liquidity concerns. And there's not really an abundance of those within US Treasuries. Yes, you had the 30-year auction last week reach for a record high, but there wasn't disorder within it. There was a strong bid to cover ratio. Investors are taking down this debt. They're just requiring a greater risk compensation to do that.
So why then do you think Scott Bessent of the Treasury decided to make this move now?
I mean, it seems very much like they want to put some kind of cap on yields, and the bias from the last couple of weeks has been upwards pressure, and they don't seem to want to pull other levers, right? So the other lever you could do is either tax hikes, less spending. We're heading into midterm elections, and we're talking about more spending still, and so that pressure on yields doesn't seem like it's going away anytime soon. So it's a signaling message from them that they can defend that level of yields. Maybe it's just the rise that they're worried about. But the issue is there's only so much you can do. You can't just keep coming in with buybacks because it just distorts the market further in terms of it's not QE technically, right? So if you do more of that long end buying, you have to issue somewhere else, and that's the front end. And the risk is you issue at the front end and you're easing technically from a financial conditions perspective is that the Fed has to hike. And all of that debt at the front end becomes much, much more expensive a lot more quickly, and your deficit could spiral quite quickly as well.
Well, I mean, you mentioned the Fed there. I just want to help me square the circle of the most interventionist Treasury Secretary we've seen in decades with a new Fed chair who wants to say far less to the markets. How should we look at that?
It seems like very, very opposite signals, especially when Warsh has come out and said that they want to hold less balance sheet. It doesn't technically make the balance sheet bigger, but it's certainly heading in this kind of more interventionist direction that's quite worrying. I think the other tension is that Warsh has said the bond market's done some of the tightening for the FOMC. If that reverses, maybe you need a more hawkish Fed to balance that, and maybe it forces them to be stronger in their messaging. And I think the worry for the dollar in particular is it puts credibility under risk. And if Warsh doesn't respond hawkishly, does that create even more pressure on the dollar and even more pressure on yields?
I mean, how serious is the credibility challenge to Scott Bessent?
I think it's quite significant, and I think you start to run into comparisons with dollar yen, because if you can't defend that level, which I don't see how you can in terms of, yes, we've gone from 2 billion to 4 billion in buybacks, that can accumulate decently quickly in terms of we have 7 buybacks left, I think, this quarter, so that's 28 billion total. But the US Treasury market is 30 trillion. Of that, the 10 to 20-year sector is something like 6 trillion. So, there's not a lot you can do, I'd say, and it just makes that bond market riskier. So if anything, it probably goes in the other direction. And if you have to continually defend it and you're not able to, it's much of a worse situation.